By now, you probably know that Elon Musk recently offered to buy out Twitter and take it private for $54.2 per share. It's a story that is happening really fast and it's also really interesting, but I think that we can use it as a case study and learn two main things from it. Do you want to know more? Let's get started. So, first of all, we can take a look at the board. Now, the main responsibility of the board of directors is to provide strategic planning and oversight. The board of directors also have a fiduciary duty, meaning that they must act in a way that is in the best interest of the business. They can only handle their powers as directors to benefit the business and the shareholders. They need to look out for the shareholders, not themselves. There is a legal aspect to being a fiduciary. It's not a nice to have, it's a must. The board directors must act that way. Now, this is something that I think you'll find really interesting. It looks like Elon Musk was offered a seat on the board of directors as long as he agreed to not buy more than 14.9% of the company. That's important because that would have basically limited his voting rights and prevented him from acquiring a large stake, which would allow him to enforce his opinion. If you have more than 50% of the shares, you basically have control over a company and can do pretty much whatever you want with it. Most importantly, you can fire and replace the directors. From the looks of it, Elon Musk has a lot of planned changes for Twitter, and that very likely includes getting rid of the current directors so that he can change the direction of the company. Basically, there's been a lot of speculation that the reason he was offered the seat on the board was so that the directors could actually protect their jobs. In fact, I think that's actually very plausible. What do you think? Let me know in the comments. If that's the case, then that's a major red flag for Twitter right now. Even though the directors are not technically involved in the day-to-day running of the company, they still have a lot of influence. Having a board which is more concerned about keeping their jobs than doing their fiduciary duty to the company would be problematic. It looks like Elon also thinks so, as he decided to make a bid for the company after he was offered the board seat with the strings attached. This leads us to the second thing that I wanted to talk about. Now, if the board is doing their fiduciary duty to the shareholders, they would be happy to agree on a good deal for the shareholders, right? When it comes to the acquisition, that's simple. Is the offer better than what the shareholders might potentially get out of Twitter down the line? If Twitter gets sold for $54.2 a share, is that a good enough deal? Let's take a look at the stock price of Twitter. Starting in mid-October, Twitter went from a high of $68.41 to $42.66 at the start of 2022, but that came down even lower to $31.3 on 24th of February. On the day that Elon Musk's 9.2% ownership stake in Twitter was revealed, the share price jumped from $39.31 to $49.97, almost 28%, and currently trades for $45.08. So, are Twitter shareholders getting a good deal? Currently, Elon Musk is offering more than the stock price at a markup of about 20%. Well, actually, there is a bit of nuance to it. When a company is acquired, the buyer typically extracts all the cash and pays off all the debt. Twitter has a debt of $4.25 billion along with cash and cash equivalents of $6.4 billion, which gives us a net cash position of about $2.15 billion. Twitter's current outstanding shares are 763.6 million, so that's about $2.81 per share that Elon will essentially acquire. So, if we add that to the current share price of $45.08, we get a price of $47.99, so basically the markup is closer to 12.9%. Still, it's more than the company is currently worth. Plus, if we consider the stock price of $39.31 before Elon's stake was announced, that's actually an even better offer. But how does the board decide whether that's a good offer or not? Easy, they hire a mergers and acquisitions consultant. In this case, it was Goldman Sachs. What I think you'll find interesting here is this. Goldman Sachs is obviously an investment bank with their own analysts. What do you think their price target for Twitter is right now? $30. They have a sell rating on Twitter. Despite that, Goldman Sachs has advised the Twitter board that the offer of $54.2 is too low. I hope I'm not the only one seeing the hypocrisy here. Obviously, there is something happening behind the scenes, but I think there are two very likely explanations. One, the advice from Goldman Sachs is superficial. Companies often hire consultants to tell them what they want to hear. It's very possible that the directors don't want to sell the company, so in reality, Goldman Sachs was just hired to agree with them. The other explanation is that Goldman Sachs' price target of $30 is either meaningless or just used to push the stock price of Twitter down so that they can load up on the stock themselves. This is actually a very common tactic by investment banks, so it's never good to take those price targets at face value. Overall, I think that this is a really interesting situation to monitor, and there is a lot of good lessons that you can extract from it. What do you think? What is going on behind the scenes that they are not telling us? Do you think that Elon Musk can improve Twitter if he buys the company? Let me know in the comments below. If you enjoyed the video, please leave a like and share because it really helps the channel. Make sure you subscribe too if you want more of that type of content. Thanks for watching, and I'll talk to you again soon.